Okay? So when we talk about materiality, an item is considered to be material if knowledge of it would affect the decision of the primary users of the financial statements. Now take note that uh, information is material if omitting, misstating, or obscuring it could reasonably be expected to influence the economic decisions that primary users of general purpose financial statements make on the basis of those statements which provide financial information about a specific reporting entity. In other words, an information is material if the omission, misstatement, and obscuring of the information could reasonably affect the economic decision of the primary users. Okay, the revised definition of materiality highlights three important aspects. Okay, highlights three important aspects. Could reasonably be expected to influence obscuring information and primary users. So again, we can say that materiality depends on relative size rather than on absolute size. And what is material for one entity may be immaterial for another. Usually, if you have capital of a big company of 100 million, the other company has only 10,000. So we can say that to the bigger company, 5,000 may be immaterial, but it is material to the smaller company. So materiality and aggregation. Now we have offsetting. Offsetting assets and liabilities and income expenses when material shall not be offset against each other. And offsetting may be done when it is required or permitted by another PFRS. So we can now say that offsetting big gains and losses, material gains and losses are reported separately. You are not going to offset. Smaller ones you may offset. The measurement of assets, net valuation allowance is permitted because technically this is not offsetting. Accounts receivable may be shown net of allowance for doubtful accounts. Okay, the next one is frequency of reporting. Normally, presentation of the financial statements is at least annually. When an entity changes the end of the reporting period and presents financial statements for a period longer or shorter than 1 year, the entity shall disclose the period covered, the reason for using a longer or shorter period, and the fact that amounts presented in the financial statements are not entirely comparable. Now, the next one is comparable or comparative information. Except when permitted or required otherwise by standard, an entity shall disclose comparative information in respect of the previous period for all amounts reported in the current period's financial statements. In other words, the financial statements of the current period shall be presented with comparative figures of the financial statements of the immediately preceding year. Then next, we have consistency of presentation. The principle requires that accounting methods and practices shall be applied on a uniform basis from period to period. Now we are now talking about presentation and classification. They shall be uniform from one period to another period. So, if you are using the first in, first out method in assigning values to the inventories, then you have to consistently use the first in, first out method, because once adopted in one year, it should be followed from year to year. It's desirable and essential to achieve for the financial statements. Okay, so we have now your general features of financial statements. Then after this, we have the identification of financial statements. Shall be clearly identified and distinguished from other information in the same published documents. Each component shall be clearly identified. In addition, the following information shall be prominently displayed: the name of the reporting entity, whether the statements cover the individual entity or a group of entities, the end of the reporting period, the presentation currency, the level rounding used in the financial statements. And these are often made more understandable by presenting information in thousands or millions of units. This is acceptable as long as the level of rounding in presentation is disclosed and relevant. Okay, now this ends chapter 1. If you have the book now, please read your book. Okay, now I'm going to take up some of these assigned questions in chapter 1 before I'll move on to chapter 2. Okay, so I will be discussing only 5 set of questions in chapter 1. Since we have 7, I will be assigning to you 4, 2, 3, 4. By the way, I will be discussing 4 and I will be assigning to you 3. Okay? Now, let's begin with problem 1-1. Now, you pay attention. I will read the question and I will give you the final answers. A complete set of I'm beginning now with 1-1. Okay? A complete set of financial statements includes all of the following components except, now the answer is D, environmental reports and value-added statements. These are not considered as a set of financial statements. Number 2, what is the objective of financial statements? A. To provide information about the financial position, financial performance, and changes in financial position useful to a wide range of users. So number 2A. Number 3. The primary responsibility for the preparation of financial statements is reposed in letter A, management of the entity. Number 4, the major financial statements include all except statement of retained earnings. Statement of retained earnings may be prepared if required. Otherwise, it will be a secondary statement to your statement of changes in equity. So number 4, D as in dog. Number 5, the major financial statements include all except statement of changes in financial position. So number 5, B. Okay, let's now continue with 1-5. With 1-5, we have 8 questions. Number 1, the overall objective of financial reporting is to provide information, letter A, that is useful for decision making. Number 2, the objective financial reporting is based on dog, the needs of the users of the information. Number 3, the primary focus of financial reporting has been on meeting the needs of which of the following groups. So B as in boy, we have the existing and potential investors, lenders, and other creditors. Number 4, the primary objective of financial reporting is to provide useful information to a letter B as in boy, capital providers. Number 5, which is an objective of financial reporting? Letter A, to provide information that's useful in making investing and credit decisions. Number 6, which is an objective of financial reporting? Letter C, to provide information useful to assess the amount, timing, and uncertainty of prospective cash receipts. So number 6, letter C. 7, an objective of financial reporting is to provide C, information useful in assessing cash flow prospect. 8, assessing cash flow prospects is interpreted to mean C, over the long run, trends in revenue and expenses are generally more meaningful than trends in cash receipts and disbursements. Okay, now we go to 1-6. Number 1, during a period when an entity is under the direction of a particular management, financial reporting will directly provide information about entity performance and management performance. So number 1A. Number 2, financial reporting pertains to A, individual business entities rather than to industries or an economy or to members of society as consumers. So number 2A. Number 3, which is not an objective of financial reporting. B, financial reporting shall provide information useful in evaluating stewardship of management. Number 4, which is not an objective of financial reporting. To provide information about the liquidation value of an entity. Okay, now we go to 1-7. 1-7, which would likely prepare the most accurate financial forecast for an entity based on empirical evidence. Number 1, boy. Number 2, what is the most useful information in predicting future cash flows? Number 2, answer is boy. Number 3, the accrual basis of accounting is most useful for letter C, predicting long-term financial performance. Number 4, in measuring financial performance, accrual accounting is used because It provides a better indication of ability to generate cash flows than cash basis. And number 5, the financial statements prepared under GAAP are not highly precise because estimates and judgment must be made. Okay. Now, the other three sets problems, I am going to still assign that to you for Thursday, no? But I told you that beginning Thursday, I'll begin giving exercises based on the assignments. Now, the scores will be minimal. However, masupot man ina. So, meaning, beginning Thursday, I will give you exercises taken from the assignments in chapter 1. And now, I am going to continue with chapter 2. Okay? So, we now have the PowerPoint presentation of chapter 2. Ha? Chapter 2 na. Sige. Hindi na to silihan. Yeah. So let's now continue with the in the study guide. We have module number 2 is for chapter 2. We have the statement of financial position. So for those who have the books, please read the book. That's more complete than my PowerPoint presentation. So we have now this statement is a formal statement showing the three elements comprising financial position, namely assets, liabilities, and equity. Siguro mo nang discuss ko, hindi ko lang discuss mag-130. Nag-record ka pa? Sige ha. I-convert ng karoon sa baba. Ha? Pagkan Okay, so we have now your the three elements comprising financial position. We have namely assets or liabilities and equity. Investors, creditors, and other statement users analyze the statement of financial position to evaluate such factors as liquidity, solvency, and the need of the entity for additional financing. Okay? Liquidity is the ability of the entity to meet currently maturing obligations as they fall due. So, the ability of the company to pay currently maturing obligations as they fall due. Okay, so we have now your we have the term liquidity. Okay, so we have so liquidity is the ability of the entity to meet currently maturing obligations. Solvency is the availability of cash over the longer term to meet maturing obligations. Information about liquidity and solvency is useful in predicting the ability of the entity to comply with future financial commitments and to pay dividends to shareholders. If you are now referring to corporations where you will have the payment of dividends. So we have the current and non-current distinction. PAS 1 provides that an entity shall present current and non-current assets, current and non-current liabilities as separate classifications in the statement of financial position. When an entity supplies goods or services within a clearly identifiable operation cycle, the separate classification of current and non-current assets and liabilities is useful information. It highlights assets that are expected to be realized within the current operating cycle and liabilities that are due for settlement within the same period. For some entities, such as financial institutions, a presentation of assets and liabilities is increasing or decreasing. In increasing or decreasing liquidity provides information that is faithfully represented and more relevant. Now for the current assets, we classify current assets, okay, as the asset is cash or cash equivalents unless the asset is restricted to settle a liability for more than 12 months after the reporting period. Now, you may have an asset cash like sinking fund cash. That sinking fund cash is created by the company in order to pay a long-term liability like bonds payable. That's why you call it sinking fund. That's why you call it sinking fund. And when you talk about the sinking fund, it's made up of cash, kwarta. However, the purpose of that fund is not to be spent for current operating needs, but the purpose is to sink a long-term liability like bonds payable. That's why you call it sinking fund. You may have cash called building fund cash. It's composed of cash. However, the purpose is to use the amount for the construction of a building. So you call it building fund. B. The entity holds the asset primarily for the purpose of trading. Uh, Trading, so meaning mga inventories. uh, Buy and sell or manufacture and sell. The entity expects to realize the asset within 12 months after the reporting period, like your accounts receivable. And the entity expects to realize the asset or intend to sell or consume it within the entity's normal operating cycle, like your supplies, your prepaid expenses. So we have to use it during the normal operating cycle. Now, current assets are to be presented in the statement of financial position in the order of liquidity. So we say, here we have the line items in the statement of financial position under current assets, and as stated, these are arranged in the order of liquidity. So you have cash and cash equivalents, financial assets at fair value through profit and loss, such as trading securities and other in-quoted equity instruments. Then we have trade and other receivables, inventories, and prepaid expenses. Now, when we talk about liquidity, we are now talking about which of the assets will easily be converted into cash. So when you say cash, cash na daan. So you do not need to convert it into cash. So maybe cash equivalents like treasury bills. So in other words, you have to convert the asset into cash. So what among the assets, which is the asset that will need the least time to convert it into cash? So maybe you can say short-term investments. You have your then followed by your current receivables, then by your inventories. So the most liquid among the current assets is cash. Okay, so non-current assets, we have the residual definition. It states that an entity shall classify all other assets not classified as current as non-current assets. In other words, what is not included in the definition of current assets is deemed excluded. All others are classified as non-current. Accordingly, non-current assets include the following. So you have property, plant, and equipment, long-term investments, intangible assets, and other non-current assets. Now, these assets are considered to be non-current. Okay. Now, PAS 1 provides that deferred tax asset is a non-current asset. So, deferred tax asset. Now, we go to current liabilities. Provides that an entity shall classify a liability as current when the entity expects to settle the liability within the entity's normal operating cycle. The entity holds the liability primarily for the purpose of trading. The liability is due to be settled within 12 months after the reporting period, and the entity does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. So we have now the presentation of current liabilities. We have as a minimum the phase of the statement of financial position shall include the following line items for the current liabilities: trade and other payable. That may include your accounts payable and your notes payable trade, because you may have other notes payable that did not result from trade operations. So we have the current provisions, short-term borrowing, current portion of long-term debt, and the current tax liability. The term trade and other payable is a line item for accounts payable, notes payable, accrued interest on notes payable, dividends payable, and accrued expenses. No objection can be raised if the trade accounts and notes payable are separately presented. Now, for the non-current liabilities, this is a residual definition. PAS 1, paragraph 69 simply states that all liabilities not classified as current liabilities are classified as non-current. So we have the examples of non-current liabilities: non-current portion of long-term debt. Now, you may have a liability payable on installment for 5 years. So, the portion payable within the current year is current. So, the portion payable beyond is already long term. We have lease liability, deferred tax liability, long-term obligations to entity officers, and long-term deferred revenue. Pass 1 provides that deferred tax liability is classified as non-current liability. So we have now your non-current liabilities. Next, we have the equity section. The equity is the residual interest in the assets of the entity after deducting all of the liabilities. Simply stated, equity means net assets or total assets or minus liabilities. Equity is increased by profitable operations and contribution by owners. Conversely, equity is decreased by unprofitable operations and distribution to owners. The terms used in reporting the equity of an entity depending on the form of the entity. So we have owner's equity in a proprietorship, partner's equity in a partnership, and shareholders' equity in a corporation. However, the term equity may simply be used for all business entities. So we have now shareholders' equity or stockholders' equity, and is the residual interest of the owners in the net assets of a corporation measured by the excess of assets over liabilities. So we have now the terms comparing those used under the Philippine terms and under the IAS term. Under the IAS term. Okay? So, for Philippine term, we call it capital stock. For IAS, we have share capital. So, take note of the alternative terms in connection with the Philippine term and the IAS term. Okay? So, we have now your line items, statement of financial position. Past 1, we have the statement of financial position shall include the following line items: cash and cash equivalents, financial assets, other than 1, 3, and 6. So we have trade and other receivables, inventories, property, plant, and equipment, investment in associates using the equity method, intangible assets, investment in property, biological assets, total of assets classified as held for sale, and assets included in disposal group classified as held for sale. Okay, for the liabilities and equity, trade and other payables, current tax asset and liability, deferred tax asset and deferred tax liability, provisions, financial liabilities other than 11 and 14. Liabilities included in disposal group held for sale, non-controlling interest, share capital, and reserves. Okay? So these are now your line items in the statement of financial position. Now, for the forms of the statement of financial position, we have now the report form following the sequence: assets, liabilities, and equity. And then we have the account form. As the title suggests, the presentation follows that of an account, meaning the assets are shown on the left side and the liabilities and equity on the right side following the sequence of an account. Okay, so anyway, the remaining time, I will just give you your assignment from chapter 2, okay? So you take the following: 2-1, 2-1, 2-8, 2-1, 2-8, and then 2 anay ka, 2